How the market wears traders out before a big move. Imagine this, you've been staring at the chart for 3 hours straight. The price is sitting right at the zone you marked last night. Everything looks ready, key level, candle pressure, volume. Your eyes locked on the screen, finger right over the entry button, but the price just doesn't move. One candle pushes up and you feel a bit of hope, the next one pulls back and doubt creeps in. It nudges up again and you think, okay, this is it. Then it rolls over and just sits there, slowly draining you. In the end, you either jump in too early or bail out too early, or decide this market isn't just worth it, and a few minutes later, the exact move you were waiting for finally takes off without you. Why does the market test your patience before the real move even starts? In this video, we're going to break that down, how the market wears traders out before big moves and how you can stop making rushed, emotional decisions in that phase. Part 1. What do we mean by wear out before a move? When the market wears traders out, the main move hasn't started yet, but the price keeps chopping back and forth just enough to drain them mentally. The price pushes into a strong resistance and a few buying waves appear, but each time the price snaps back down. Then it comes back and tests the same level again. From the outside, this can look like normal price action, but when you are already in a position, every single candle turns into a question. Is it going to break it now? Did I read this wrong? Should I get out early? Those small doubts gradually erode clear decision making. The market doesn't always push traders out with one big aggressive move. Sometimes it simply tires them out mentally until they take themselves out of the game. Part 2. Why does the market get so confusing before big moves? Big moves usually need liquidity. Before a major level breaks, a lot of orders build up around that area. Some traders place buy stops above the resistance. Others put their stop losses for short positions in the same zone. And some enter early, before any real confirmation. As a result, the price will often attack that area several times. It pushes into it, maybe runs a little higher, snaps back down, then repeats the same pattern again. These swings make impatient traders jump in too soon, make nervous traders close too soon, and make emotional traders flip their bias over and over. And once liquidity has been trapped and collected, the real move starts right when many traders are too tired or too frustrated to make a clear decision. Part 3. Common trader mistakes in this phase. In this wear-out phase, traders usually fall into 3 traps. First, entering too early. It feels like it's starting. If I don't get in now, I'll miss it. But the level has not yet broken or been confirmed. The price is still inside the range, and that entry is driven more by fear of missing out than by logic. Second, exiting too early. The analysis is fine, the level is solid, but because the price takes its time, the trader gets tired of waiting and closes the trade. A few candles later, the price finally moves exactly in the direction that was planned. Third, constantly flipping bias. At first, there is a bullish scenario. After a few rejections, the bias suddenly flips to bearish. Then the market turns again and the main move happens in the original direction. The problem is that decisions are being made in response to each candle rather than guided by a clear plan. Part 4. How do we know if the market is loading up for a move? Not every sideways move means a big breakout is coming. Sometimes the market is just messy and the best move is not to trade at all. To filter this better, focus on 3 things. First, see if the price is moving inside a clear range. If you can define a meaningful high and low and the price is respecting those boundaries, there's still structure. If candles are random with weird long wicks and no clear direction, that's probably not a good decision-making environment. Second, look for price compression. When the swings inside the range get smaller and the price starts getting squeezed into tighter zone, it shows that energy is building up. That compression near a key level is much more meaningful than the same pattern in the middle of nowhere. Third, location matters. Grinding action near a strong support or resistance, yesterday's high or low, or an area that had a strong reaction before, has more weight. If the price is just going sideways in the middle of useless zone, that chop doesn't necessarily mean anything important. Part 5. How do we protect ourselves in the wear-out phase? First, have a clear scenario before you even enter. For example, if the price breaks this level and holds above it, I'll look for longs. Or, if it fakes out above the level and snaps back into the range, I'll look for shorts. When you've already defined your if, then scenarios, you're not making a new decisions on every tiny move. Second, choose your decision-making time frame and stick to it. If your analysis is based on the 4-hour chart, you can't let every 5-minute candle scare you into changing your mind. A lot of bad exits come from exactly this mismatch: higher time frame analysis, lower time frame fear. Third, don't feel forced to trade everything. Sometimes the best move is to let the market show its hand more clearly. A professional trader doesn't care about being the very first in. They care about having enough solid reasons to stay in once they do enter. Protecting capital during these wear-out phases is just as important as catching the big move itself. Part 6. Wrap up before big moves. The market doesn't always behave cleanly. Very often, it pulls in the impatient, shakes out the ones who can't sit through the noise, and makes the emotional traders change their minds multiple times. If you don't have a plan in this phase, every candle has the power to knock you off track. But if you know exactly what structure you're waiting for, where you're willing to be patient, where you want to enter, and where you're ready to walk away, the wear-out phase has much less power over your decisions. In a way, before the market moves, it first wants to make sure that enough traders can't handle waiting. Think back to the last time you closed the trade too early and then watched the price move exactly where you expected. What was really behind that exit? Fatigue, fear, or a missing plan? Share your story with us in the comments.